Ashwini Agarwal, the question which I am persistently asking everyone on the show today is that exactly a week ago, everything was on our side. Crude had collapsed, Fed had changed stance, flows were back. But today, looks like it's bad news all over, all over again.
Well, Nikunj, we are going through a scenario where the fear right now is essentially politics, which is more of, I think, a short-term sentiment than anything else. If you analyze the mood of the voters, I still think that it would be premature to extend what happens at the state level to the general elections. However, obviously the market is today reacting to the exit polls that got published on Friday post-market, and of course the fact that crude oil has jumped up a little bit. So that's causing some concern as well. But I think in the short run, it is essentially the politics that's driving the sentiment down. I personally don't worry too much about it because of multiple reasons. Number one is, if you do a past analysis starting 1989 to till today, markets and stability of the government, or whether it's a coalition government or whether it's a majority government, hasn't really determined market returns. Second is, I think the core economy is doing quite well. We are starting to see earnings growth come through, and if that trend sustains, then I think valuations and earnings growth will determine the direction of the market than politics. And last but not the least, as I mentioned, I don't think we can forecast what happens at the state into the center so easily. I think voters have started to think differently about these two elections.
Just put a data out, Ashwini, that the impact of state elections does not even last for 48 hours. So I think markets with each passing state election are getting more and more accustomed to the fact that in India, kahin na kahin par state election hamesha hota rahega. So I don't think that's a worry. The worry for me, Ashwini, is the fact that autos are slowing down, consumption numbers are not looking all that great. If I look at the November data, cement demand has not been strong and steel demand also is not great. Now, as we roll over from 2018 to 2019, unfortunately, all the brokerages are making a case of a 15 to 25% recovery. And looking at the anecdotal evidence, the consumption has also started slowing down. It's hard to make a case for earnings recovery.
So great point, Nikunj. But the November data you have to analyze with two issues. Number one is NBFCs obviously got hit very hard in terms of availability of finances to them, and they are preferring to conserve liquidity at this point rather than give out loans. So that would have had an impact on auto demand in particular. Second thing is that Diwali last year was in October and this year was in November, and that tends to kind of move things around a little bit when you compare year-on-year numbers or even month-on-month numbers. Typically, it is during Diwali that a lot of construction workers would go home for 3 or 4 days or 5 days, leading to a lull in construction activity. So I think we have to look at this data on a 2-3 month basis before concluding that the economy is indeed slowing down. Having said this, the second half of the current financial year, you will see slower growth as compared to the first half of this financial year, purely due to base effect. As in the first half of this year, we had a base effect of first quarter of GST, being introduced on 1st July last year. So sales in the first quarter of last financial year were low. And in the second quarter of last financial year, I think many companies were dealing with the GST implementation, and one might surmise that things were a little bit slower. So on a year-on-year basis, first half was quite strong. Second half, we don't see that tailwind. But if I look into the financing issue, I think the banks are stepping up, and I think that's great news. Till now, most of the NBFCs seem to have enough liquidity to meet their short-term needs. And as the system normalizes, as the banks start to lend more, I think availability of finance on consumption may not be such a big constraint. Yes, at the margin it might affect a few borrowers who are unable to borrow from the banking system because of sectoral limits or because of specific prohibitions or whatever it is. But outside of that, I don't really see such a big impact. So I think we have to see the data for another couple of months before concluding that the economy is significantly slowing down. I am taking the November numbers with a bit of a pinch of salt.
Right. Ashwini, having said that, do you think that 2019 see 2018 has been a nothing sort of year when it comes to returns on the back of a splendid 2017. From a return expectation, what do investors brace for in 2019? Because as I see the calendar, I can't really see why investors would take a directional call on the market because the event risks are so many.
You're right. I think the first half of 2019 can continue to be a period when we may not see a significant upside because people will wait to see what happens in general elections. There will be a lot of noise around various issues. So I think you might see, the market probably bouncing around here or there, not doing too much. But I think the key to the market outlook is the earnings growth trajectory. So if you look at the Nifty earnings, for example, this year, like all years, everybody started out with 22-23% earnings growth, but in the first 2 quarters, there has been some trimming down. But most of the issues that led to the trimming down were transient, such as high energy prices, high input costs on materials, which are not there in the second half. So if you actually see an earnings growth of something like 12 to 15% getting delivered this year compared to negligible growth rates for the last 3 years, I think that should provide a shot in the arm for the marketplace. Second thing is that mid-cap valuations, which are very extended in 2017 calendar, as you pointed out, have corrected meaningfully. I mean, the mid-cap indices are down quite significantly this year, varying from 25% to 33% depending upon which index you look at. And valuations there are now quite compelling. I agree that mid-cap returns require risk appetite to return, so maybe it's a second half 2019 story rather than first half. But my experience tells me that whenever valuations become very attractive, earnings growth is decent, then I think it's a great time to be buying. My sense is that political noise will sort of be something that we'll all become accustomed to, assuming the earnings growth story delivers. If that happens, then I wouldn't worry too much about 2019 being another dog year like 2018. I'm actually more optimistic about 2019 at this point in time.
Okay, so valuation's attractive and earnings growth is relatively stable. What pockets of the market do you believe these two factors are sitting in well?
So we quite like the domestic banks. I think you are seeing a significant reduction in credit costs for the banking system. Across the private banks, the private industrial lenders, and across the PSU banks, you will see a significant reduction in credit costs going into fiscal 20. So bulk of the credit costs are probably behind us. So you will see significant earnings growth there. That's an area we are very positive about. The other area is the domestic industrial demand. If you look at the recent earnings reports from a lot of the industrial equipment manufacturers, you will find that the numbers surprise positively for the September quarter and the order books are looking quite strong. Similarly, domestic construction order books are also looking quite decent. So I think the domestic industry overall is looking quite reasonable. A third area where I think value investment can be made is in the area of cement. Sentiment is completely crushed here. But if you look at the profitability on a per ton basis, it is at levels at which no new capacity can be created. New capacity additions in the current financial year are likely to be significantly lower than what was forecast at the start of the year. So capacity utilization should pick up as we go through the year, and that is bound to result in pricing power 6 to 9 months from now. So that's one area. That's another area where things are looking quite interesting. Healthcare stocks are quite cheap across the board, and I think one has to cherry pick, of course, based on what one is comfortable with. But that's another area where we find a reasonable amount of value at this point in time. So there's a large number of companies, sectors where I think valuations are very reasonable. Earnings outlook is actually improving, and I think those are the areas one should be looking at. And this is, of course, in addition to the small and mid-cap names, where across the board valuations now are looking very, very attractive relative to the growth.
If you're bullish on the economy, if you're bullish on earnings, if you're bullish on cement utilization and capacity to pick up, then why not simply go and buy metal? Metal stocks have been beaten black and blue. The metal demand is also going to remain strong if you are optimistic on global growth and local growth. Tata Steel has come down from 700 to 500. Vedanta has come down from what levels of 300 to sub 200. And these are again high beta names, which is that if you get them right, you may end up making 15, 20, 25% in just a jiffy.
Yeah, Nikunj, you're right. I think there might be some very nice trading opportunities in the metal names that you spoke about. Unfortunately, metals have a lot more determinants for their outlook just compared to cement, which tends to be a more domestic industry where the factors are much more forecastable. In metals, I'm not certain as to what's happening on the global demand scenario. And over a period of time, I have personally learned just to ignore the metals because there are just far too many determinants into those stories. So yeah, they present trading opportunities from time to time, and you may be right, there might be some very decent short-term trading upside available there. But unfortunately, I don't really spend a lot of my time studying this sector because of the volatility and unpredictability of the outcome. So unfortunately, I'm not able to offer any insight there.
When we look back and remember that the ugly patch of September end and October beginning, the NBFC sell-off, for those who kept their calm and invested sensibly, they've emerged as winners. So in this current leg of turmoil, I'm using turmoil not for the Nifty but for small and mid-cap stocks, metals and some other names. For those who will keep their calm, they will be rewarded or for those who will realize that, look, the time has changed and it's time to sit on cash and markets are headed much more lower. So will the greedy stock pickers be rewarded, or will the realistic, cash hunters be rewarded?
Nikunj, short term, I don't know what happens. Like I mentioned, short term, there will be political noise and there will be a lot of speculation surrounding change of government and what happens and what doesn't happen and so on and so forth. The way I think about it is that if you buy stocks when they are attractively valued from companies that have a history of delivering on their promises, where balance sheets are not stretched and where cash flows in their history have remained reasonably encouraging, and they don't have a corporate governance concern. If you put all these things into the mix, and you can find a lot of small cap and mid cap stories, even large cap ones where valuations are quite attractive. I think in the medium term, and I would define medium term as 1 year plus, you will be rewarded. My personal view is that it might be too late to raise cash and sit on cash at this point in time. That was, of course, in hindsight, something that one should have done at the start of this year or late last year. But it doesn't seem sensible to do that at this point in time. Short term, of course, I don't know what's going to happen. 3-6 months are extremely hard to predict. The global environment is in a complete flux. The US-China trade war fears, which had subsided at the start of last week, have again resurfaced. So if there is a global event that leads to a massive risk off, that's something that I just can't predict or forecast, and that's a risk that all of us run while investing in the market. So I prefer to look a little bit beyond a couple of quarters, and I think that's the only way one can make reasonable investments.
Okay. How would you, Ashwini, look at the consumption story right now? It's coming at a price, but it's really the safeguard measure to protect against volatility that we could be facing into 2019. Now, I know consumption is a broad basket, but do you think that, you know, when it comes to the India story, staples and discretionary can never disappoint?
Well, staples, the underlying demand is of course very, very long-term and sustainable in nature, but valuations are quite challenging. I mean, I was looking at the price earnings bands for a lot of the consumer staple companies last week, and several of them are trading at all-time highs. All-time highs going back into 15 years, 20 years in terms of valuation ranges. So I think clearly that trade has done well. It's very well played out, and in hindsight, you know, in any market sell-off, it is the quality and predictability that gets a premium, and which is why the consumer staple stocks have done so well this year. We are value investors, and we find it very difficult to convince ourselves to buy a consumer staple name which might be trading at 50 times or 60 times historic earnings, with an earnings growth which is somewhere in the region of 15% or 18%, when I can buy similar earnings growth stories at 12 times or 10 times or 14 times earnings. And this is more true for the staples rather than for the discretionary demand products. And on the discretionary demand side, we are seeing some opportunities where stocks have corrected 30-40%. Yes, there are some headwinds to near-term outlook, but very well managed companies over the long run, and this is another area where the domestic consumer will sustain and continue to grow over a long period of time, so these look interesting to us. So I think you have to sift through. It's not a one size fits all, but yes, there are some consumer discretionary plays which look interesting.
Okay, and industry ancillary to consumption, autos, I think it's the fourth or the fifth year of an upcycle that we are in when it comes to auto sale numbers, and not just in November, but for the last 2-3 months, the trend has been slowing. Stocks have corrected in tandem. Maruti, M&M, Bajaj Auto off from 3,000 odd rupees. So what would be your strategy when it comes to autos? Earnings are in a bit of a flux, but then again, correction has been seen.
So you're absolutely right. Autos have been correcting for the last 3 or 4 months, and growth numbers haven't been very encouraging. This is more of a base effect. Like you said, auto sales have been growing for 3 or 4 years, and now I think there's a base effect catch-up that's happened in some of the leading consumer auto names, and I think that's why you're seeing the correction in stock prices. My sense is that some of them which are down 25-30% are starting to look quite attractive. We don't own many autos at this point in time. We had felt towards the end of last year, beginning this year, that they had become quite expensive and expectations were quite stretched both on sales as well as on margins, and we are quite pleased to see the kind of correction that's come through. We are looking at several of these names, and a couple might look interesting at some point. At this point, not really very sure whether it's the time to jump in. But yes, they are beginning to look interesting.
All right, Ashwini, appreciate your time. Thank you for joining us.